Are you also wondering whether it is worth investing in the EABL corporate bond or whether to just invest in the Treasury bonds? In other words, we are all aware by now that East African Breweries has floated a corporate bond. They are looking at receiving 11 billion from the market. Now, you as an investor, what do you need to know before you make a decision as to whether to invest in this bond, whether it is worth it, or whether to invest in the Treasury bonds? In other words, in this video, in today's episode, we are going to be comparing investment in Treasury bonds vis-a-vis investment in corporate bonds using the lens of EABL, because that is the active bond that we have right now. We have other bonds in the secondary market, but right now, that is the primary listing that we have at the moment. All right. So what is the differences between investing in the corporate bonds and investing in Treasury bonds? Are there any similarities? What is their risk like? Do they carry the same risk level? What is the expected returns like for the corporate bonds vis-a-vis the Treasury bonds? So if these questions sound like answers you'd like to get, or if these topics or subtopics sounds like something that might interest you, then you might want to stick around. And also, like I say in other videos, you need to have a piece of paper and a pen, because we are going to have some arithmetics in the video. Okay. My name is Berlin, and thank you so much for tuning into your home of financial freedom. Before we continue, I'd like to request you once more to please press the subscribe button. Smash that subscribe button for me if you haven't subscribed. It's my way of knowing that whatever videos I'm sharing with you is of value. Also, if you find this video valuable, please do share it with your friends, share it in your communities, share it in your WhatsApp group, so that whatever information that we are sharing here can reach other people. You can also feel free to ask whatever questions you'd like to ask in the comment section. I would like our comment section to be engaging, all right? Now, like I told you, I would like us to compare investment in corporate bonds vis-a-vis investment in Treasury bonds. What is a corporate bond? A corporate bond is a debt instrument issued by a corporate being any limited company, all right? Any limited company. However, for this corporate to issue the bond, it must be approved by the Capital Market Authority, which is the regulator for capital markets. Now, once the Capital Market Authority has approved such issuance, the paper will be floated to the public, and then investors are going to make a decision as to whether to invest in that paper or not. So a corporate bond is a debt instrument by a corporate, the private sector. All right? It's a private sector. It's a company coming to borrow from us, from the public. Okay? A Treasury bond, on the other hand, is a debt instrument by the Treasury, quote unquote, on behalf of the government, any government for that matter. So any country can issue a corporate bond. When a country issues a debt instrument, that's a corporate bond or a sovereign bond. But corporate bonds, that's a Treasury bond, or a corporate or a sovereign bond. But corporate bonds, on the other hand, is borrowing by corporates, and Treasury bonds is borrowing by the government. All right. So that's one of the differences. So, having defined what a corporate bond is and a Treasury bond is, why do companies come to borrow from the public instead of going to borrow from the bank? We know that the commercial banking sector is there to extend credit facilities to the public, including these corporates. So why would EABL come to borrow money from you or from me? Why would EABL come to borrow my 10,000 shillings, being the minimal amount, and not go to borrow money from KCB with a core capital of almost over 300 billion? What would entice a corporate to come to borrow from me my 10,000 shillings, your 10,000 shillings, and everybody other's 10,000 shillings to cumulatively make the 11 billion, not walk into one of the commercial banks like KCB, like Stanchart, like Equity, like Absa, like Copbank, who have the ability to lend 11 billion to EABL in one stance like that? Or maybe just half of it, and then they borrow the other half from the other bank. Why would they want to come to borrow from us? Now, companies issue corporate bonds for a number of reasons. Number one, When they're borrowing from the public, it is an unsecured loan. It's unsecured creditor. When you go to borrow from the banks, such a significant amount of money, most banks, if I was the credit officer, regardless of the policies of that bank, I will need you to secure that debt. Okay? So borrowing from the public is unsecured. And when you go to borrow from the bank will most likely, more often than not, ask you to collateralize that facility. All right? Now, secondly, when you borrow from the public, you dictate the terms and conditions of that debt, of that borrowing. Because you are the originator of the contract. You dictate the terms and conditions of that debt in your book. You dictate when you're going to pay the interest. You dictate the terms, the interest rates, and what have you. However, when you go to borrow from the bank, you do not dictate. You can only negotiate for the terms. And banks are bound to give terms and conditions. We call them conditions precedent and conditions subsequent. Condition precedents are the conditions that you need to meet before the money is given to you. Condition subsequent are the conditions that you have to meet. Even after the money has been given to you, the bank will still be, quote unquote, on your case. The bank will still be on your case, sometimes even imposing restrictions on you. For instance, the bank can give you on condition that you must bank with them. You cannot open another account with another bank. The bank can give you a condition not to open a new branch. The bank can give you a condition not to borrow more, even when you have need, not to borrow more without the bank's consent, or not to expand without the bank consent, or not to acquire without the bank consent. So when you borrow from the banks will give you restrictions or conditions. Sometimes these conditions, companies can find them a bit limiting, or the process of having to go to seek approval from the bank for you to make a corporate move, okay? So that is one of the reasons why corporates would prefer to issue a corporate bond vis-a-vis borrowing from the bank, because the corporate bonds come with fewer restrictions as opposed to borrowing from the bank. Another reason why an institution would prefer to float a corporate bond, borrow from the public, and not borrow from the bank, is that it gives this corporate visibility. By the mere virtue of the fact that when you float a bond, for instance, EABL, the previous paper that they floated back in 2021, they needed to raise 11 billion, but the public were willing to lend EABL 35 billion. That gives EABL a lot of credibility. The public has a lot of faith in EABL. It gives them a lot of visibility. Like right now when they're floating the current paper, everyone, all the papers are talking about EABL, about this bond. What is that doing? How is EABL benefiting from that against their competitors? Free marketing. It's giving them visibility. Even investors, it's even making their shares more attractive in the market. It's giving them some good visibility, especially if you are a corporate that has been able to service your debt well. You have a good balance sheet for as long as you don't default in that borrowing, okay? Now, another reason, quite critical, why companies would issue bonds or float bonds or borrow from through bonds vis-a-vis borrowing from the bank is interest rates. Interest rates risk. They are mitigating their interest rates risk. Why? In this paper that has been floated, the interest rate is fixed. It is not subject to variation. And if it was to be variated, then EABL will reserve the rights to vary that interest. In this case, it is a fixed term, it's a fixed interest. For the entire 5-year period, EABL, their cost of funding is fixed at 11.8%. All right? However, if they were to borrow from the bank, banks always reserve the rights to vary interest rates, except for very few cases where they offer fixed rates. But in more often than not, because banks are subject to interest rate risk exposures, they do reserve the rights to vary the interest rates. Why? Because when market rates fluctuate, then they also have to receive deposits from the public at the varying interest rate. So if they gave you a loan at 11% fixed for 5 years, and then at year 3, the market rate increased to 18%, and they have to be paying their depositors 14% on deposit, the bank will make a loss, earning interest from you at 11% and paying depositors at 14%. So to mitigate that risk, banks will always reserve the right to vary interest rates. However, in the case of floating a bond, EABL has fixed that interest rate. So that is an advantage. They have mitigated the risk of interest rates fluctuations in their book. What are the major differences between investing in the EABL bond and Treasury bonds? All right. Now, the issuer is the first difference. EABL, in the case of the EABL bond, EABL is the borrower. Treasury bond, CBK, is the borrower. Now, the purpose of the borrowing is also different. The EABL bond is going to be used to, it's actually for a debt restructure, because they are retiring an 11 billion bond and borrowing 11 billion bond. But it's for their corporate use. Treasury bonds are used for government expenses. The requirements are also different. If you want to take up the EABL bond, you need to be having a CDSC account, the account that you use to trade in the Nairobi Stock Exchange. And if you want to open that an account, I'm going to share with you a link in the comment section. Click on that link and go ahead to open a CDSC account. If you want to invest in Treasury bonds, on the other hand, you need to have not a CDSC account, but a DAO CSD account. So the central depository accounts are different. For the EABL bond is the one that you use for trading in stocks. For the Treasury bonds, it's DAO CSD account. I hope that is clear. The minimum amount is also different. The EABL has floated or has put conditioned their borrowing to a minimum of 10,000 shillings. Government securities or Treasury bonds, the minimum amount is 50K. EABL has made it easier for people with who have less than 50K to take up this investment opportunity. The multiples also are different. EABL is floating at 10,000 shillings, multiples of 10K or incremental of 10K. The government securities are at 50K and incremental of 50K. Trading in the secondary market. For the EABL, you will use your CDSC account. You will see it listed there in your portfolio. For the government securities, you'll need to use through a broker as well, okay? And the taxations are different as well. EABL, it's subject, the EABL bond is subject to withholding tax of 15%. The Treasury bond varies. There are bonds which do not carry any taxation, like the IFB. There are bonds which are taxed at 10%, the ones which are 10 years and above, the long-term papers. And there are bonds who have the same taxation of 15%, just like the EABL bond, the ones which are less than 10 years. But CBK will always communicate to us in advance in the prospectus how much taxation is there, yeah? Another key difference between the EABL bond and the Treasury bonds is on the maturity or on the redemption. This specific EABL bond has a 5-year redemption, but EABL has reserved the rights. In fact, let me read that for you. The issuer may redeem all or part of the notes on any date, subject to not less than 15, no more than 30 days, calendar days, prior notice to the note holders. So in other words, EABL has reserved the rights to pay us back our principal or to prepay us before the maturity of the paper. All right, which is a good thing, by the way. Another difference that I have noticed in the EABL and the government securities is that in the prospectus for EABL, they have a default clause. I'm not saying they're going to default, but they have a default clause. It says default rate 2% above the fixed interest rate. In other words, should EABL default in paying you, they are going to pay you an extra 2% above the agreed rate. In Treasury bonds, there is no default clause because the chances of default
is almost negligible.
Key difference that you need to know as an investor is that investments, the paper, the EABL bond, when you invest in the EABL bond, chances of you using that investment as security to borrow or to access credit from a financial institution is unlikely. However, when you invest in the Treasury bonds, you can use that paper as collateral. You can actually borrow against it. As a matter of fact, the Star newspaper has reported that Standard Chartered Bank has unveiled a loan facility backed by the CSD government bonds. All right. It says the bank said that the facility is designed for affluent customers who purchase government bonds directly from the CBK. Loans will be offered at competitive interest rates and will not attract a arrangement fee. It goes further to say, our aim is to help investors unlock the value of their government bonds purchased via DAO CSD. The facility can be used for investment or personal needs with a minimum loan amount of 50,000 shillings. That is also the minimum amount that you invest in Treasury bonds, yeah? And the maximum amount, and the maximum based on the size of the client's bond portfolio. With the EABL bond, I doubt that you can access a credit facility from a bank and use it as collateral, even though that is with the EABL bond, like I've said, I doubt it's unlikely that a bank will be willing to accept it as a collateral, yeah, because those are two tiers of credit risk. The bank will have to access your credit risk as the borrower, and the bank will have to accept the counterparty credit risk, which is now the credit risk of EABL. Okay. However, if it's the same bank where EABL is banking, maybe that bank will consider, but that is based on bank policies. I deviate. What are the similarities? Now, both the Treasury bonds and the EABL bonds have two possible gains. Number one, you earn money through coupons, and you have the potential of making capital gains. Capital gains in the sense that you can sell your papers in the secondary market at premium. All right. Both of them, both the Treasury bond and the EABL bond, can be sold in the secondary market. Another similarity. At the same time, remember I've told you can make capital gains from both papers. You can also make corporate capital loss from both the corporate bond, EABL bond, and the government bond. When interest rates increase and you're holding a lower coupon paper and you want to dispose it, then you might have to dispose it at a discount. However, if you don't sell, then you don't make a loss. The capital loss and the capital gains are only paper losses or paper gains. You actualize it when you make the actual transaction. Both the government bonds, the Treasury bonds, and the EABL bonds are fixed return investments. You know in advance when and how much you'll be earning your income or your return on investments. At the same time, they're both similar in coupon payments. Both the Treasury bonds and the corporate bonds are going to pay interest or coupons biannually. All right. Now, what are the risks? What is the risk comparison like? Are the risk levels the same? Do they have the same risk level? Let's begin from inflation risk. It is the same. Why? Because inflation risk is the same across board. For people, whether you have invested in the Treasury bond or whether you have invested in the EABL bond, you are subject to the same inflation. So inflation risk is the same across board. Reinvestment risk is also the same. What is reinvestment risk? Reinvestment risk is the risk that when your investment matures, at the end of the 5 years, when EABL is paying you back your money, at the end of the 7 years, at the end of the 20 years, or at the end of the 2 years, when the CBK is paying you back your principal, the interest rates in the market rates will have reduced such that when you are reinvesting these, you lose value. Okay? I mean, the risk that the market rates will have reduced when your paper matures, so that you stand a chance to reinvest it at a lower rate as opposed to the rate at which you are holding that paper. So that is reinvestment risk. Both EABL and Treasury bonds are subject to reinvestment risk. Liquidity risk. Well, I think the market is more appreciative of government bonds because they have a lower default risk, which we are going to discuss, as opposed to corporate bonds. And so I expect the market to be more actively trading on government bonds, treasury bonds, and not the corporate bonds. Therefore, the corporate bond, the EABL bond, carries a slightly higher liquidity risk as opposed to the treasury bonds. All right? Default risk. Government bonds has low, very low, almost negligible default risk. Corporate bonds has a higher default risk as opposed to government bonds. As a matter of fact, in Kenya, historically, the government has never defaulted in meeting its obligation, debt obligation, specifically paying its interest or paying the principal as and when they failed due. However, we have experience in the market of corporates who defaulted in meeting their debt obligations. We had Nakumatt that defaulted in their bond. We had Athi River Mining that defaulted in their bond. We had Chase Bank that defaulted in their bond, and we had Imperial Bank that defaulted in their bond. There could be others, but those are the ones I can remember offhand. Yeah. So I'd like us to do a tabulated comparison for investing in treasury bond vis-a-vis investing in the EABL bond. Yeah. And let's call our investor George. So George in this case is going to invest 1 million shillings in both cases. So you put a bid of 1 million in the treasury bond, specifically FXD1 2012-2020. This is the latest auction that had an almost similar tenor to the bond. To the EABL bond. This paper had a tenor of 7 years, and the EABL bond has a tenor of 5 years. So assuming we invested 1 million, or we put a bid of 1 million in this treasury bond, it was auctioned at a discount. We are going to pay Remi to CBK 978,440. Why? Because it was trading at a discount of 97.844 shillings. Remember, this paper had a coupon rate of 12%, therefore a net coupon rate of 10.8% because it has a tax rate of 10%. So we are going to remit to CBK 978,440, but earn coupons on the 1 million. So our coupon was going to be, our net coupon was going to be 108,000. And for the 5 years, I'm doing 5 years so that I compare apple to apple, as opposed to doing 7 years vis-a-vis 5 years, yeah? So for the 5 years, we were going to earn 540,000 shillings, and you have your paper holding of 1 million. So your sum of investment at that particular instance at year 5 will be 1.5 million. However, I'm alive to the fact that interest rates might have changed or varied at year 5. So your paper could be your paper valuation could actually be less than 1 million if you had to sell it. If you had to sell this paper, you'll actually earn less, or you could actually earn more if the rates will have dropped. Okay, so I'm alive to that fact, but we are going to assume that you are not selling your treasury bond paper. You continue holding it for the remaining 2 years. So if you don't sell it, then your investment will be worth 1 million, and you'll have received a sum of 540,000 shillings, making your sum of return, making your sum return on investment 561,000 shillings. Comparing that to the bond, to the EABL bond. Now with the EABL bond, we put a bid of 1 million. We remit to EABL 1 million because it's being sold at par, and the net coupon for EABL is 10.03%. Remember, it's subject to 15% tax. That is after the tax. So coupons will be 100,000 shillings, meaning that the net coupon, meaning that the sum coupons during the 5 years, assuming also that EABL does not call back the paper. So then for the 5 years, you are going to earn 501,500 shillings against the other side where we saw 540,000 shillings, right? And at redemption, at the end of the 5 years, EABL will be paying you back your 1 million, meaning that the sum payment is going to be 1.5 million, 1,501,000 in EABL against 1,540,000. Okay, so if you are to pick the Treasury bond vis-a-vis picking the EABL bond, we'd had a chance to earn more on the Treasury bond against the EABL bond. However, disclaimers. The paper that I have used, the Treasury bond I have used, is a 7-year paper, and the EABL bond is a 5-year paper. Another disclaimer, I have assumed that EABL is not going to call up that paper. So my independent opinion as Berlin, and this is not financial advice, my own opinion is that there should be a relationship between risk and returns. Investment in corporate bonds have a slightly higher risk of default as opposed to investment in treasury bonds. And therefore, as an investor, we need to be compensated for that risk of default. I'm sorry, this might ruffle some feathers. But as an investor, if I'm if I'm taking an asset that has a slightly higher risk, I expect compensation for that. As a matter of fact, CBK had launched risk-based lending. In other words, CBK has told banks that you need to be able to risk assess your customer so that the clients who are less risky, the ones that when you give money, chances of default is limited, ought to be earning less. Ought to be paying you less, lower rates, lower interest, as opposed to the high-risk creditors, the ones who are listed in CRB, the ones who have history of default, the ones who are borrowing without security, the ones who have a higher chance of default. Risk-based lending. The higher the risk, the higher the loan. So this hasn't quite played out for me here, but I understand as a borrower or as a corporate, you'll want to lower your finance cost as much as possible. So yes, looking at it from EABL lenses, it makes a lot of sense to pay the lowest coupon rate possible. That is also why CMA actually approved it. But looking at it as an investor, myself as an investor, Berlin as an investor, I would have wanted to be paid more, maybe even 13% or 12%. However, yes, being a shareholder of EABL, I am happy that they're actually looking out for my interest as a shareholder of EABL by minimizing their financing costs so that they can actually earn more and make more profits and pay me dividends. So I am gaining on both sides, okay? That's how I'm looking at it. At the same time, EABL has given us an opportunity to diversify our investments and increase our potential for earning more. So that is the only reason why I feel comfortable taking up this paper. However, if I wasn't having shares with EABL, then knowing that I have a chance to earn more by taking up the FXD1 2012-20 paper, I would have gone for that over the EABL paper. But status quo, will I be taking the EABL paper? Yes, I will be taking the EABL paper, knowing very well that I am not adequately compensated. All right? When you make an investment decision, you make it having understood the risks that you're getting yourself into and how you mitigate that risk. All right? Now, do you see why I keep insisting that you need to subscribe to this channel? If you don't subscribe to this channel, some of this information will pass you because this is not a conversation that is being held in any other platform. My name is Benny, and thank you so much for staying around. Please don't forget to press the subscribe button, and let's meet on the next video.